There's a lot going on here, and there's a lot of talk about wokeness and ESG and whether ESG is real and how ESG should be measured. And you have a very provocative view about all of it.
Look, I think it's actually pretty simple. Over the last decade, what we've seen is large asset managers have mandated U.S. energy companies to produce less oil, to produce less natural gas. And, Andrew, what that's led to is a generational energy crisis, a massive supply-demand imbalance in the United States and around the world for fossil fuels. Now, the good news is U.S. energy companies can actually capture that opportunity, but they can only do it if they are liberated from these ESG mandates and these ESG constraints. And that is what we're bringing to the table with Strive. We're listing this new index fund, DRLL, on the New York Stock Exchange today. But what Strive is doing is delivering a new mandate, what I call the post-ESG mandate, to the U.S. energy sector to drill for more oil, to frack for more natural gas, to do whatever allows them to be most successful over the long run without regard to political, social, cultural, or environmental agendas. And if they do it, I think that's actually an opportunity over the next decade to see a renaissance of U.S. energy trading not at a discount to the S&P 500 that these companies do today, I think in large part due to this ESG-linked investment consensus, but rather to trade as they have for much of the last 30 years at a much higher multiple, closer to parity with the U.S. tech sector, closer to parity or even in excess of the rest of the S&P 500. And I think that's an opportunity to not only unleash the potential of U.S. energy stocks, but also, more importantly, to shore up American energy security in the process as well. So that's the new post-ESG shareholder mandate.
There's a lot of questions about fossil fuels, the need for fossil fuels right now, and I think there's no question that in this particular moment, and I think we've learned from national security, from a national security perspective, from an economic perspective, that the transition is going to take a long time. And so there's no question that these energy companies are going to be important. I think that one of the reasons that there's been a discount, though, on many of these energy companies is because 10, 15, 20 years from now, it's unclear what the other side of this looks like. A lot of them are investing in clean tech. Do you think they should be investing in clean tech?
I think we should be more precise about what we mean by clean tech. So I think oil and gas companies should invest where they have a competitive advantage and should not be wasting money where they don't have a competitive advantage. How I sum that up is molecules, not electrons. What do I mean by that? Even in other future hydrocarbon energy and sustainability plays, like in hydrogen, they actually have competitive advantages. They're building pipelines. Carbon recapture, a conversation we should be having. That is different from just wasting money, in my opinion, on wind and solar, where oil and gas companies have no inherent competitive advantage. In fact, Exxon, even back in the 80s, invested in IT. It was actually a blown wave of investments.
Okay, so when you look at the steps that Exxon is taking, for example, around carbon capture, or you look at the steps that Chevron is taking, or you look at the steps that others are taking even around wind and solar, and there are many, you think they should not be in those businesses?
That's true for wind and solar generally. As I said, carbon recapture and hydrogen, those are conversations that we ought to be having if they have inherent competitive advantages. But, Andrew, I think that misses the deeper point, which is when we focus on the core businesses, oil and gas production, you talked about the energy transition. Let's talk about what that transition actually looks like. Less than 3.5% market share for fossil fuels over the last 30 years, and we only picked off the lowest hanging fruit. So I don't think you're right. In capital markets, there is a debate today on whether or not there's a future for fossil fuels after 2030. I personally think that the answer to that question is clear as day. Fossil fuels are going to be here to stay for a long time to come. And what the ESG investment consensus has done is caused investors to value these companies as though there is no fossil future after 2030.
But that's the thing that I'm unclear about, which is at some level, as an investor, don't you have to take into consideration, and I actually think this is where even Larry Fink has been on this, which is you have to take into consideration the cultural shift and move, whether you think it's woke or otherwise, almost is irrelevant. I think it's an economic argument, which is if you, and by the way, maybe it's political. If you have pension funds around the world, especially in Europe, who are continuing down this path, by default, that means that there's less investment money going into these same companies, which means that their multiple is going to be lower than it otherwise would be, no?
So with due respect, Andrew, I think that's a little bit circular. The question isn't where the funds are flowing. The question is where the funds should be flowing. And there are equal number of pension funds on the other side of this, from states ranging from Texas to states that aren't on the coasts of the United States. So I think the real debate is, as you said, this should be an economic discussion, not a cultural or political discussion. And as an economic matter, let's just talk about, for example, you brought up BlackRock. why was it in Chevron's best interest as a company for BlackRock, State Street, and Vanguard to vote in favor of Scope 3 reduction targets at Chevron, where an oil and gas company is asked to take responsibility not just for its own emissions, but even downstream uses of its own products? Why should the Amazon Prime truck that's delivering food to your house be counted against Chevron's own Scope 3 emissions? These are the kinds of mandates that ESG investors have specifically imposed on U.S. oil and gas companies, and I think that has made these companies less successful. It's made them trade at lower multiples. It's made them systematically underinvest in their core competitive advantage, which is oil and gas production. And what this sector needs is a new mandate. I'll just share with you, Andrew. I spoke to the largest, or one of the largest conferences, U.S. energy conferences of U.S. executives yesterday in Denver, the Enercom conference. I will tell you firsthand, they are hungry for this message. They are waiting for a new shareholder mandate.
Vivek, I'm sure you are their hero.